Hello again and welcome to another edition of London Direct. Akshay Kapoor always has something interesting to say, and as officials meet in Brussels to discuss bankers' bonuses, I've been back to the offices of Gekko Global Markets to discuss banking regulation with him. At the moment in Brussels they're discussing bankers' bonuses. What officials want to do is limit the amount of bonuses that bankers can get so it doesn't exceed basic salary, but isn't there a case that bankers should get rewarded whatever they want, even if it does mean big bonuses?
I think everybody should be rewarded for their performance, and I think decisions on rewards should be made by the people who are cutting the check, which is basically the shareholders.
So you think regulators should keep well out of it?
Absolutely. I see nothing that they can achieve by regulating bonuses, and especially after regulating it to the extent that they want to regulate. I think, frankly, this feels a little bit more like driven by other factors rather than sensible economics or sensible incentive systems.
But do you think there is an argument to say that the way that the bonuses are implemented could be done in a more intelligent way, rather than just giving a big cash bonus, that they could be done over a number of years, or not just cash through other assets as well?
No, sure, but these things were implemented very soon after the financial crisis. I'd be very surprised if any large bank gives significant amounts of bonuses in cash. If any large bank does not defer significant amounts of bonuses. And also a lot of banks that I know of give bonuses in structured assets and that kind of thing, and in equity. So I believe the two main aspects of bonuses, so one is deferring them for the long term so that long-term performance becomes important, and the other one is linking it to the profitability of the company as a whole. So to equity, I think these issues have been achieved a long time ago. So I'd be very surprised if there are people who don't do that anymore.
Sure. Let's move on to the UK. We discussed this briefly last time we spoke. So there's this ring-fencing idea which the government has thrown its weight behind. They're going to ring-fence the retail banking sector for the so-called normal people and separate that from the investment banking sector. It does seem slightly flawed in the fact that if we took the example of, say, Barclays investment bank, that if that went bust or went into difficulties, that would the normal retail clients not still get worried about their Barclays retail bank? So what do you think about this idea of ring fencing?
I think you make a very important point. My view on ring fencing is I still haven't been able to figure out what problem we are trying to solve. So do you have any idea of the kind of problem that is being tried to solve by ring fencing? It's
to stop a run on the banks, isn't it? So we don't have another Northern Rock where we have people queued outside banks trying to take all their money out.
All right, so that's depositor confidence, right? Now, if we need depositor confidence, the only thing that can give you depositor confidence is a lot of capital, right? Ring fencing will not work primarily because of the reason that you said, that if Cap goes bust, Barclays will still come under pressure. And if Barclays comes under pressure, Cap will also come under pressure. That's number one. Number two, the majority of the problem in terms of not having enough capital to repay loans is on the retail side of the business. If you look at the balance sheets of most retail banks, you will see that they have huge mortgage assets, naturally, but the retail deposits that they have to cover those mortgage assets are very less. There is a fallacy in certain circles who think that it is a retail bank which actually funds the investment bank. That might be true for short periods of time, but if you look at loan to deposit ratios overall for retail banks, they are over 100% in most cases, which basically means that retail deposits are less than retail loans, which certainly means that they are not giving money to the casino banking, so-called casino banking operations, which are not. So most of the problems that we've seen, like Northern Rock, HBOS, RBS, all of these problems emanated on the retail balance sheets. And ring-fencing will not solve those problems.
So they need to be more careful about who they loan money to in terms of just mortgages or
Absolutely, absolutely. And the fundamental problem here is this. You want a stronger bank, you need more capital, less risk. Simple. I think governments understand that. On the other side, they seem to believe that more lending is a way out of the financial crisis. Now, you cannot square this hole. You cannot square this hole. If you want stronger banks, if you want less risk in the financial system, you need less loans. However, politicians don't want that, right? It is easy to say, hey, banks, lend more. So on the one side, you're asking the bank to lend more. On the other side, you're saying, hey, be more risk-free. And the other thing is, we still haven't had a bankruptcy code in banking. We've still not resolved the most important problem of too big to fail or bank failures. Banks have to be allowed to go bust. Banks have to be allowed to go bust. Their creditors must stand in line like everybody else in the bank, like it happens in the bankruptcy of any other company. And the depositors have to be protected. And there is a deposit protection scheme to the extent of £85,000 per account. But we probably need a little bit more. And I think the fundamental problem here is this. There's a feeling in some parts of government and some parts of the media that it is finance which drives economic growth. Finance is just the grease that greases the wheels of the car. It is not the engine that drives growth. So to confuse the engine with the grease, we'll keep going round and round in circles and keep chasing our own tails.
Well, Akshay is always a good listen. Next time I'll be speaking with Miles Eakers and Mike Van Dorken, but for now, goodbye.